And all of a sudden, I, as a tech company or as Shopify, can start providing this through that Wombo combo of Galileo and SoFi together.
Did you say Wombo?
Wombo combo?
Wombo.
Wait, what's Wombo?
It's an old Smash Brothers Melee meme that he's talking about.
Oh, you just reminded me of SpongeBob. Do you remember that episode?
Stay on point.
You remember that episode though, right? The Wombo.
Okay, dude.
You remember, Tannor, you remember it or no?
Keep that.
Bro, everyone in the chat recognizes it's 46 seconds. Let me play it. It's 46 seconds.
Dude, do not do
it's 46 seconds. That's it. Then we'll get back. We'll get back.
SpongeBob. I am also.
Man.
You're just demonetizing all of us.
Why do I even try anymore?
I promise it's not going to it's 46 seconds. They're not going to demonetize. I promise.
Absolutely will. Ladies and gentlemen, welcome
To Instacart Weekly, baby.
You got so much hate for that one, hey?
You know, the irony, bro, is I looked at the numbers and I think everyone saw the stat. They made $711 million off just advertising, which means they're a tech company more than they are just a grocery platform. Like when you make 700 million, that's almost $1 billion off ads. That's 1/4 of Twitter's revenue.
What part is not a technology company?
I mean, people were saying that it's a grocery platform, right? So yes, it's a tech company in the same way that Netflix is a tech company, but it's just a media company. But
yeah, when he says people were saying they're a grocery company, it was only Amit.
No. There's a lot of bearish articles. You haven't read enough about Instagram.
Chris posted his article yesterday on student loans and how that was going to be driving some pretty positive results in 2024.
What has happened over the past 3 years is the weighted average interest rate, the return they're getting from the student loans, and then the cost of capital of those student loans, as you can see, they've kind of become very slim. As a result of that, SoFi has not been able to make a strong NIM or net interest margin or spread on student loans. That is changing, is what Chris is saying, as we get more originations. And as a result of that changing, he says by 2024, full year, SoFi should be able to originate about $1.6 billion in student loans. We are not going after bachelor's degrees. We're going after master's degrees, these like lawyers, doctors, these type of people. And I didn't know that. I actually was confused on that subject. We're going after people who are in more elite arenas, which means they're likely to be less delinquent on it. And as a result of that, there's $1.6 trillion in student loan. Chris Hager's point was we just have to get 0.01% of that market for that to have a meaningful impact on SoFi's EBITDA by full year 2024.
Why are we talking about this right now? Well, student loans is coming back. The interest is starting as of September 1st. Payments are going to be starting as of October. So in the fourth quarter, student loans is going to have a part to play. The 1.6 billion was the bullish scenario. It goes from 1 to 1.3 to 1.6. That was the range Chris had in terms of bearish, baseline, and bullish. It's still fairly good, right? Because this is Q4 of 2023, and we expect an acceleration in that ramp as student loans goes back to full force. In 2020, they were doing over 2 billion in originations.
Which is insane.
Back whenever all this came crashing down, we were doing about $400 to $600 million in personal loan originations. Now we're doing 3.7 billion. So everywhere where student loans lost, personal loans picked up, and yet now they're both going to be going after each other. Lending Club thinks that there might be a potential where student loans is cannibalistic to the personal loan market, that if people are having to pay their student loans back, that they're not going to be as quick to pile on more debt because now they can't afford it.
I think the way that you need to look at that is human nature responsible? Most people are not responsible. People may have thought student loans weren't coming back. They may have thought it was actually going to get forgiven. They may not have planned for the future. And now they're going to have to rebudget with payments starting back up. That could impact short-term spending because they have to reallocate money toward the repayments. Is it going to hurt personal loans is a much different question because people take out personal loans for a lot of different things. You're not taking out a personal loan to go buy a computer. You're taking a personal loan to do work on a house. I don't know that you're really going to see that get hurt. Most student loan payments are how much? $500-600 a month?
Not for masters.
For the customers that SoFi is trying to go after, I think the 70,000 student loans was their average or something along these lines. And that was about a $700+ bill. If they amortize it across like 20 years, it would be something like $550.
That's a significant bill for a lot of people. The majority of the population, that's a significant bill. I think you're going to see people possibly spend less on credit cards and spend less on consumer goods. I don't know that they're going to spend less on large projects or large expenses that they would need a personal loan from.
actual net interest margin really collapsing on student loans is true, but I don't think that that chart is accurate enough to really see how much it's actually closed out. What that chart is not telling you is that that's all the student loans for SoFi held totally. Like, for example, I think we're holding $5.4 billion worth of loans right now, which are, some of them have much longer maturities at much, much lower interest rates. We're only signing on about 400 million new student loans right now. The rate at which these new loans are increasing interest for the weighted average is not fast enough. The actual new loans that we're signing on right now are probably along the lines of about 8-9%. I don't think that it's a fair comparison comparing our overall portfolio with the growing current state of cost of capital. The net interest margin of the new loans that we're signing are a much larger margin than what that chart tells you, because we're not signing at 4.9%. We're signing at much higher rates.
We
Comparatively.
need to see a couple of months worth of data. It's not really worth speculating on this because we have no idea what's going to be right and what isn't going to be right. Chris's numbers look good, but I mean, we need a couple of quarters.
I'm really, really excited for the student loan moratorium to end. I haven't looked into how much Biden's new plans, like the SAVE plan and stuff like this, are actually going to impact that or slow down the new amount of people that are re-signing up for personal loans. This is going to be popping off. The student loans, home loans are going to be popping off during that same time. Hopefully, personal loans are not being cannibalized by these new products. All while SoFi brings on more SoFi Invest members. SoFi money is still popping off and everything is going so well.
Seeing personal loans decline a little bit, as long as student loans and mortgages go up and originations grow overall, I'm not concerned at all. And I do think 2024 will be a good year for originations. We could see a correlation, which I'm very interested in. Look, this is more of a 2025 thing, what I'm about to say, but I want to see if there's a correlation between mortgages going up and personal loans going up, because you could have people buying houses and then deciding to do remodeling or deciding to do other capital projects on the house.
Definitely.
And maybe they're not tapping a home equity line of credit. Maybe they are not taking out additional capital on a mortgage, and maybe they're going to tap a personal loan instead.
Do you know the two most common reasons why people took out a SoFi personal loan? So number one, debt consolidation. And then a large part of their growth during 2020, 2021 was solar installs. In fact, it was so large, they talked about it in an earnings call.
I want to come back to just your earlier point around student loans eating into personal loans. To some degree, I'm sure there's going to be a subsection of people that might be affected by that. But I mean, we've been through a time where inflation has been rising. Credit card debt is like all-time highs. The fact of the matter is that like they're restarting. There's going to be originations that are not zero, right? There's going to be a growth in those originations. This was SoFi's main business up until 2020, right? Regardless of how fast or how slow that ramp is. I mean, even Chris had like a 600 million variance in just what that number is going to be for Q4. It's going to be starting up regardless of what the macro is at that particular moment, which is a net positive for SoFi, and it's going to be positively affecting their numbers.
One of the best things that Chris said in any of his recent articles was that SoFi's moat is them differentiating themselves while being in the same market as their competitors. They continued to grow quarter over quarter and is still seeing new highs. It's very different versus the competitors. And why is that? It doesn't have to do with APY. Whenever looking at Lending Club, they held higher APYs than SoFi. There was a bunch of other competitors that hold higher APYs, and that's still not the differentiated factor.
What's the main selling point on SoFi? So what's the rate on federal student loans? They're lower than what SoFi can offer. So the only selling point to refinancing is extending the payoff period from 10 to 20 years.
So new originations are lower than what SoFi can offer. But that doesn't mean that existing ones aren't. That's what the $200 billion total addressable market is. There's $1.7 trillion worth of federal student loans out there right now. 200 billion is in that certain amount of interest rate that SoFi actually thinks that they can go after. That's excluding all the FICO and credit scores. There still is a massive amount that people could actually refinance that would actually be cheaper to go with SoFi. And then what they've already noticed is that there's some people that would rather take, let's say instead of 7% that they could get with the government, they would take 8% if they could extend it over 20 years instead, because then that means that the monthly payment would go down. You could take something that would be 700 and like I was talking about before, 700 plus dollars, I think it's like 730, 740, and then lower it to 550 per month. but yet you're extending it over an extra 10 years. Whether that's a smart financial decision for an individual, that's up to them. But it is an option, and that could lead to a ton of originations for SoFi.
Something else, I made a video about this on Monday. Galileo updated their developer documentation to account for SMB lending. So basically what this allows Galileo to do is, as part of buy now, pay later, this is B2B, for them to offer to small and medium-sized businesses the ability to create lending products. Now, obviously, they either need to have a banking license or a partnership with a bank, essentially somebody who has a banking license. Some of the use cases that SoFi highlighted here in their documentation is startup capital, working capital, and expansion capital. And if you look at some of the benefits down below, Amit, if you'll stop texting and just scroll a little bit more.
Dude, my girlfriend, bro, she's like crazy. Like,
yeah, my girlfriend. Yeah. My body pillow in the other room is vibrating. Sorry, trying to turn it off.
You know, I think this is interesting. SoFi is definitely going to be the partner bank, right? For people who want to be doing this. How I was imagining it is, let's say Shopify wanted to provide loans to some of their merchants on their platform. Shopify doesn't have the infrastructure to do that, so they would do it through Galileo with a partner bank, where Galileo is essentially the provider. Through their APIs, they're providing the recipient business the ability to lend to other merchants. Basically, this is what they can do. They can simulate a loan so that they can compare different APRs, different loan terms. They can customize the loan however they want to. They can then see the status of their loan. They can see the burn down of their loan, the payment schedule. They can charge off accounts. They can disperse funds. Now, the interesting part is the synergy here with Galileo and SoFi, because SoFi has a banking license. They have the bank charter. And so let's say I'm Shopify. I don't already have a relationship with a bank. This can come as a bundle where Galileo can be offering me the infrastructure. SoFi is the partner bank getting a percentage off that. If you're looking at it through a one-dimensional lens, you're thinking about the benefits to Galileo. But then if you look at it through this multi-dimensional lens with SoFi being the partner bank, then it's mutually beneficial to both companies because they can essentially bundle that offering to have like this full suite of white glove service to whatever recipient bank.
SoFi's business is giving loans, right? Galileo is their tech play. So if their tech play is coming up with a lending API, essentially product for small businesses that is within the wheelhouse of what the parent company is making golden money off of, I think that's really cool. That makes a lot of sense. How successful will it be? I don't know, but it definitely seems like there's a massive market for small businesses.
Galileo's had lending APIs for a while. This is just very specifically for small to mid-sized businesses. I'm still excited about it. This could open up possibilities for partnerships with companies similarly to Shopify or Square Seller rather than just Cash App. Like, there is a lot of opportunity here, but it's not like this is the Galileo's first trip in lending. My connections did leak that SoFi just got in a bed with Experian, launched a new beta for a product called Experian Smart Money. But Experian Smart Money, they sent out emails to over 1 million people, and it's going to be one of the large financial institutions that Galileo just launched with. And that was just the other day, 2 days ago.
Yeah, we're definitely going to see a resurgence in the tech platform. Management has given us that blueprint. They said, hey, margins are going to be hit. Growth is going to be hit. We're moving from on-prem to cloud. We're making these cuts on the Galileo side, and everything is going to come back towards the end of the year, right? So we expect a resurgence in growth in terms of technology accounts towards the end of the year. We expect a resurgence in the margins that we've come to expect from Galileo and Technisys as a consolidated business now. From everything that we've been seeing in terms of little product drops or partnership, they're executing on that. There's no reason for us to be doubting that they're going to be missing any of their expected numbers. Goldman Sachs conference is going to be on Wednesday, September the 6th at 4 p.m. Eastern or 1 p.m. Pacific time. Anthony Noto is going to be speaking at that conference in a fireside. These conferences in the past have been golden opportunities for us to get nuggets of information and overall strategy about how management is thinking about things.
The Goldman Sachs conference is going to be huge. I think this is going to be very big only because you have student loans coming back. And I think that we're going to see some really good insights. I'm very excited for this. And I'll probably do an article on the conference next week going into SoFi Weekly.
The next piece of news, SoFi to launch a new enhanced yield ETF with options strategies?
It says in the principal investment strategies that the fund seeks to achieve its objective by combining a strategy of holding U.S. government securities, including U.S. T-bills and treasury bonds, with a credit spread option strategy. So 2 to 5% they're going to hold in cash and cash equivalents, 95 to 100% in treasury securities, and then up to 90% credit spreads using the fund's holdings of treasury securities as collateral for the fund's investments in options. The fund will invest in a portfolio of U.S. Treasury bills and/or U.S. Treasury bonds with a targeted portfolio duration of approximately 1 year. They will generate annual interest income and capital gains. At the same time, the fund will purchase put or call options on the following three major equity indexes: the S&P 500, NASDAQ 100, and Russell 2000. For those that are not familiar with a credit spread option strategy is a derivative that involves buying and selling options on the same underlying asset. So it's very interesting because you see how big JEPI is and JEPQ is from JP Morgan. I don't have it up. I think JEPI has like a 29.37 billion in assets under management. JEPQ has 5.22 billion. This is interesting because this is investing in T-bills using it as collateral, doing an options overlay with credit spreads on these indexes. So it's going to be very interesting to see the type of yield that this could generate. With how big these other products have become, this could be a big generator, because when you think about JP Morgan's charging 0.35%, got 35 billion in assets under management, they're charging 0.33% as a management fee. That's just reoccurring revenue. That's great. I mean, I'm all for this. They are products geared toward income investors or people who are interested in generating in this case, monthly income. And it's not buying this to match the market. It's buying it to either one, generate income every month they're taking as cash, or two, put a block of money into it, generate the monthly dividends, reinvest them, create additional dividends every month and generate compounding, and then eventually take it as cash. Options have really come to fruition over the past couple of years. 5-10 years ago, there were not a lot of people in the option market. Now there is, and there's actual products. Basically, instead of writing cover calls the way I do, you can just buy QYLD or XYLD, and it basically buys the companies in the S&P or the NASDAQ 100, does a cover call overlay and generates a double-digit yield. So this is going to be interesting because there are people that want to own products like this to generate the higher yield, and we're going to get management fees on it. It's very smart they're doing this because there is a big segment of people that like this, in addition to closed-end funds that do something similar. I can see them advertising this on risk reversal media, stuff that Liz Young does on Dan Nathan and Guy Adami's podcast. I can see it on some of those other things. So it'll be interesting to see what flows into this.
Did the post highlight, Stephen, when this is going to be starting? I think it was October. I think they said towards the end of the year.
Yeah, I didn't see that in here, but I didn't read it word for word. I just skimmed through it to get the broad strokes.
Yeah.
So can we be honest?
Am I going to buy it? Most likely.
Yeah, this is like an absolute nothing burger. I can't stress it enough how small the ETFs on SoFi are. Not even a single one of them has $1 billion in assets under management. Like meet Kevin's funds are larger than all of SoFi's ETFs. I manage more money through my career than most of these ETFs.
It's not about today.
No, I know,
tomorrow,
but it's
about
probably
next
costing
month,
us more money to pump out all of these crappy ETFs that no one wants, rather than just doing what has worked always, which is their SoFi Select 500 ETF. Eventually, you have to start to think about the 80-20 rule and just do the big important products first and stop putting out this crap that they're probably putting more engineers, developers, and asset managers towards that is just losing us money. It's not even a product like worth even covering, in my opinion.
For them to create a wealth management on and to have a robust product offering that appeals to more investors than just your standard index fund investors, you're going to need a suite of products. This fits a need for income investors, and typically income investors have more money to invest. They've already made their money. They're looking to generate yields. This is a pathway to get more money coming in assets under management.
We have SoFi weekly income ETFs, SoFi weekly dividend ETFs, both already exist. Okay, let's look at this, the weekly dividend, which everyone freaked out about.
It's got 10 million in management and it has a 3% yield. People aren't getting excited over a 3% yield.
Yeah, 10 million assets under management. It's costing them more to run this thing than for what they're making. ETFs, remember, are like some of the smallest earning portfolios. This is not active management. This is passive management, right? So you're making no money on this. And it was created back in 2021.
You have to look at the bigger picture and the down the road. This is about creating a product that appeals to a certain group of investors and to bring more money in. And eventually they'll have a large product suite. You get bigger, Star Wealth Management, they will be generating expense ratios. It's about building out that brand and just having more products, because look, we don't know what the yield's going to be, but if the yield's going to be in the 8 to 12% range because of this options overlay strategy, it's going to become very appealing against these other products, especially since the base is not holding stocks, the base is holding treasuries. Theoretically, there should be less fluctuation than these other funds. So that's what makes this very appealing. So for somebody that wants the high yield but doesn't want the fluctuation that a QILD or a JEPI has, depending on what the yield is, if this is 8 to 10% or 8 to 12% and it doesn't really fluctuate that much, you're going to see a lot of people probably consider it. As the Fed cuts rates, you need rates to go down to make stock yields that are in the low single digits more attractive. And as rates come down, these high yield funds are going to look very attractive.
Not to mention the 0.5% expense ratio on top of that, which is going to eat into your earnings, which is really low. I'll give it. I mean, it's not low compared to ETFs, but it is low compared to managed funds for sure.
Yeah.
More products, the more cross-selling, everything like this, I'm happy. But like these very small niche ETFs, I've never understood why people get even remotely excited or to post on Reddit or in Twitter or whatever. It honestly should be looked at as a negative aspect of the company right now, as it's just going to bring in losses.
Long term.
Do you know how little 10 million in assets under management is?
But if SoFi is going to become a very large financial institution, they're going to have to grow out their wealth management. And if they do, they will be able to put backing behind it and get clients interested in it. And once again, there's a reason that these high yield covered call or call option overlay strategy ETFs have a large asset under management. There are a lot of people that are very interested in them.
Steve, we talked last week. I gave you my due diligence. How come there's no article yet on Seeking Alpha for Robinhood? Because I need
bring the
you
value
to pump
investor
the
into this.
stock
Let's hear.
so that I can make money. Why haven't you done it?
Well, first, as I told you on the freaking phone, I don't write articles for any other reason than they're my opinions, and I haven't finalized my opinion on Robinhood yet.
Okay, so let's hear your opinion. They're gap profitable. Tannor thinks the company's full of shit. They bought back 55 million shares today. They took 7% of the float off for shareholders. Stock was only up 1%, which is great to me because that means the market still doesn't get it. And that's like,
what is it? What happened? Oh, they're buying back stuff?
They're buying back Sam Bankman-Fried's shares that he had bought back in May 2022, which is good. I think he bought around this price anyway, or maybe a little bit less. Maybe he made a profit on $8, something like that. And then they bought it all back for about $606 million. And the stock ran up 2%, even though they bought out 7% of the outstanding share base. The investors don't like that. They didn't like the
No. You're wrong on this, Tannor. Investors hated that there was 55 million shares that theoretically could have been dumped on the market and would have flooded and diluted them. But so I think a lot of institutional investors were waiting for this. It's been a year since this deal finally happened.
Yeah, no, it seems like they loved it. The stock's up 2% on a 7% forced purchase.
Yeah, but the stock's also up, I think, like 10% in the past week or 2 weeks. It's important that we got this part resolved. Look, I agree with you. His Tanner's FinTech Frenzy today was basically like, if the August numbers for Robinhood suck in terms of monthly actives and all that stuff, then they're in a bad spot. But I don't think August numbers mean everything, because I don't think August was the best month in the world. But I do think that if we see, and we saw a lot of inflation data, we didn't talk about that, it was on the right side. If that leads to the Fed pausing over the next couple of months, we should see those MAUs go up. If it doesn't, you're correct, Tannor.
The problem is I find that June and July 2020 were those very amazing months, and the numbers didn't improve.
I think a lot of investors were hesitant those 2 months because it was the first 2 amazing months after a year and a half.
The way I'm looking at Robinhood is it's interesting, and I'm considering, haven't made up my mind yet, starting a position. Got over 5 billion in cash on hand. Total debt 3.1 billion. So they have more cash on hand than debt. And they are now GAAP profitable. I want to see if it stays GAAP profitable. I may not start a position yet. I may wait for one more quarter of data to see if they're GAAP profitable again. But for some reason, people seem to use it. It could be a good acquisition target. I mean, you got 7.18 billion in total equity on the balance sheet, and the market cap right now is 9.9 billion. You're not paying that much of a premium on the company's equity. If they keep increasing revenue, and if they continue to be GAAP profitable, what's the underlying tech worth? What's the book worth? I mean, TD Ameritrade got bought out for a healthy premium. E-Trade got bought out for a healthy premium. It's not far-fetched to say that Robinhood of all companies can't fetch a solid premium on an acquisition. And I would like to think that there are a bunch of companies that would benefit from adding that book of business in. And if rates start to come down next year, and if we do go into a bull market the way I think we're going to, regardless of what the next couple of months are, even if their net interest income declines, they should make money from trading, which should offset it. So it's interesting. The fundamentals kind of make sense. I don't see much downside from here. Basically, my premise.
Yeah.
And I'm trying to figure out what the upside is and if it's worth buying some shares and just selling some calls against them at a little bit out of the money. And if they get called away, great, made a profit and made some immediate income.
I do actually think you're right. I don't know what the how much downside there actually is, just because of the large cash base that actually they hold. So I think that's fine. It's mainly just the upside. I just feel like everyone that I talk to tells me that this is by far the best platform. Aside from you, Stephen, you'll say think or swim, but that this is the best platform to invest on.
And when I was on TJ's podcast and he was using it live with me on it, I was really shocked at how easy and intuitive it is. And I will say the options part looked very well done.
Yeah.
I think the overall product is not for me. But obviously, a lot of people like it, and they're not gravitating away from it.
I don't understand what you mean by the upside is the like if you're buying into the thesis that they're an acquisition target, the upside is pretty healthy. I mean, it's if you're thinking that, okay, well, they're 10 billion and their float is decreasing and they're going to get a healthy premium, whatever, let's say 15, maybe higher than that, sure, and they're going to get bought out. Well, hell, like that's pretty much why we're investing in PayPal for 50, 80, maybe a percent, maybe a 2x, 100%. The ups, you can't be like, okay, well, that doesn't have upside because it's whatever, a potential 100% return.
Schwab bought Ameritrade, Morgan Stanley bought E-Trade. We've already seen consolidation in the past year. We could see more, and it would make sense that the fintech companies are going to need to consolidate to gain ground and create a wider moat. Ally Financial, it would be an interesting company to acquire. Robinhood. Ally has a good amount of cash on hand. They're a strong company, strong bank. Robinhood would fit right in. That's a bolt-on acquisition. I don't know. There's companies that would benefit from synergy, even if it's a merger, not an acquisition.
I was going to say probably more of a merger, right?
Yeah. I mean, I'm not completely sold yet, but I don't think it's a dumb idea by any means. And I don't see a lot of downside from here. Like, yeah, sure, it could go down, but I think it's backstopped with the amount of cash they have.
Did you take a look at their stock-based compensation? Like while we're waiting for the stock to go up, did you see how much they're diluting?
Yeah, I mean, the stock-based comp is down from 2021, but it's still high. And that's also something that I would
down
like
from being
see.
46% of revenue down to 22 is quite the.
I get it, but at the same time, if they're able to be GAAP profitable with the stock-based compensation, I've said about other companies, I'll say it about them. If they're going to grow profits, I don't have problem with them paying their employees through stock-based comp, because then their employees have more skin in the game. It's when companies are losing money and they're diluting through stock-based compensation that I have a problem with it. So if they can keep the gap profitability going and growing in addition to revenue, I don't have nearly as much as a problem with stock-based compensation. That's why I need another quarter of data before I even think about putting money in. But it's interesting. It's very interesting at the moment. So Tannor, I want to show you something before we go.
Sure.
We are going to start Alternative Asset
Oh my
Weekly,
goodness.
and I made another purchase.
Oh, you texted me this.
9.8. I don't even know what that is, but that's
that a comic book?
that's a perfect Spider-Man comic right there.
Autographed by the legendary Todd McFarlane.
How much did you pay for that?
Not a lot. I paid
Five figures?
265.
4 figures?
No, I got so
No,
it
265.
sold the other day for
200?
Yeah, $360 it
Oh, come
sold
on,
for
man.
the other day.
ETF says looks fake to me.
I paid $265 for it, but what I do is I look for auctions that
Wait,
end during the week.
$265. That's it?
Yeah,
I'll buy one too, man.
it's not
Wait,
a
for an
lot.
that feels like nothing for an autographed.
Yeah,
comic
and the worst part about it is he says he's up on the investment, and the problem with alternative assets is you need a buyer to be up on your investment. They're
Yeah,
like,
it's
the
so
liquidity
hold
on those
on.
products are
The
so
last
low.
one that sold had over 40 bids on it. These are liquid. You can
Oh,
sell
okay.
them at any point. If you look at bids that end during the week at obscure times when people are sleeping, you can get stuff under market value because most people,
Steve's waking up at 4 a.m. to buy these things.
maybe,
Just
Excited
outbidding
about
some kid in Asia.
I may set an alarm in the middle of the night and get up and check my auctions and my stuff I'm
Steve,
bidding on. Yes.
so-
All right, Steve, we got to go. We got to end this.
Last
one.
question.
We
Last
gotta
question.
end it.
With that comic book, can you ever like flip through it and just read it, or do you have to?
No,
Like,
no, they're closed.
No,
No, you
it's
can't open this
sealed.
shit. It's
Once it's graded, you can't touch it.
Yeah, it's graded. It's sealed by CGC, but you can buy a regular version and flip through it if you want.
all right. That's it, everybody. Hope you enjoyed. See you next week.